Ring-a-ding-ding, there it is, today's closing bell at the New York Stock Exchange.
Let's see where the numbers wrap up the day. A lot of happy folks there, and they're probably enthusiastic seeing all this green. The Dow Jones ending the day in positive territory. Numbers still settling, but about a gain of 140 points. The S&P 500 and NASDAQ also ended the day relatively flat.
Well, David Traynor joins us now. He's the CEO of New Constructs. Hey, David, so tell us, what was driving the market today?
I think the market's still sort of trying to digest all of the kind of crazy news that we've seen over the last few weeks, as well as what's really going to happen long term with the Fed. What's that terminal rate going to be? Because I think right now the stock market and bond market disagree. Usually that means the stock market is wrong, but I think the stock market is got a little bit too rosy expectations about where interest rates might be in the medium and long term.
Right. And we know that while, what happens on Wall Street in the stock market is just one indicator of the economy. It is not the entire economy. But we were speaking with a guest yesterday who mentioned that the collapse of SVB really did put a chill on how Americans view their regional banks. He was describing it as a real backbone to the economy because it, lifts up so many small to medium businesses. And we know President Biden has called for a set of reforms today to safeguard the banking system. How do investors see all of this in the wake of SVB?
I think investors need to understand that this is not a big deal. I mean, what happened with Silicon Valley Bank was fairly anomalous. I mean, those guys sort of failed banking 101. I mean, you could not have really run your bank much worse than the way Silicon Valley ran that bank. First Republic also had an enormous amount of concentration in its deposit base. And that's just bad business. And I think what you see more than anything from these failures is a symptom of the ultra loose monetary and fiscal policy that we've seen over the last 10 years. The moral hazard that everyone's been talking about came home to roost in those banks. And it's going to come home to roost in a lot of other companies that are going to get pinched as liquidity continues to get tighter, because there's just no longer an infinite amount of money to throw after bad money.
Yeah.
By that, what I'm saying is companies that lose money aren't going to be able to get more debt anymore.
Right. David, let's talk about the labor market. There's a lot of indicators. They seem to be really all over the map. Weekly jobless claims risen to a 3-week high. Layoffs remain low, but we're also hearing about many in different industries. What's your assessment of the labor market right now?
I think the labor market is pretty strong. And this is going to be, if we have a recession, it's going to be very different because the consumer is strong. So it's going to be an interesting sort of tightrope that the Fed has to walk in terms of keeping the economy strong. And that's really the dichotomy between corporate America and the rest of America, right? Corporate America had too much money and they made a lot of bad decisions, and there needs to be a lot of culling of bad investments, including bad stocks, especially zombie stocks. Mm-hmm. And whereas in the rest of America, the consumers, right, they're pretty healthy. Balance sheets look good, jobs look good. So that's also a big part of what drives inflation and keeps these zombie companies going. And so the Fed is really has so much room to still to work in terms of reducing money supply, reducing liquidity, so as to carefully cull out the cancer in the economy, which is a lot of these zombie stocks and zombie companies, without doing larger harm to the rest of the economy and creating a big recession. And I think that's the key, is what they're trying to do. It's just hard. It's never really been done before.
All right, David Traynor, thank you for joining us.
Thank you, David.
Thank you.